Hey, it's Mike at Cross Country Mortgage, and it's time for your Monday morning mortgage update for the week of November the 11th. But it's the 12th because yesterday was Monday and it was Veterans Day. So we got a short week of trading this week in the market. And our gratitude goes out to all of our veteran clients, our friends, our family. We wouldn't be here if it wasn't for you. It was your day, and we hope it was a great 3-day weekend. I had a great 3-day weekend. We honored our veterans on Monday. Went and saw a great film in town at the Cascade. Gail and I got out to the Whiskey Town trails and rode the horse and the bike out there. I did some fly fishing. Just a real packed weekend, ready to hit the ground running this morning. So let's talk about what happened with the market last week, what's going to happen this week. I always try to give you insight, tools, and tactics so that if you're out there buying and selling, you can make some decisions based on what's happening in the market with your rate and with your loan programs. If you're representing somebody who's buying and selling, you can have some insight about those conversations that you can have. So what happened last week? Well, let's just go right to the charts. I always try to show you uh, really what's happening in the market in real time, and visual is always good. So this is a chart that I show every week. Typically, it's the trading of mortgage-backed securities in the bond market. Mortgage rates are determined by the trading of those mortgage-backed securities in the bond market, not the stock market, not when the Federal Reserve raises or lowers that Fed fund rate. It's a trading of mortgage-backed securities, long rates in the bond market. And this shows a 6-month average. And you can see these candlesticks. The green candlesticks means money's flowing into the bond market. And that means that you see that the graph moves up in those green candlesticks. And that means rates are getting better. The red candlesticks, if you look at the right here, means money's flowing out of the bond market and rates are getting worse. So what we've seen over the last 3 weeks plus, I mean, if we look really the entire month of October, is a gradual worsening of interest rates. We saw a little flat spot at the second week in October, but really the last 3 weeks, we haven't seen any improvement to rates. Every week we're seeing rates go chip away a little higher, higher, higher. Well, last week was different. We saw rates, or the pricing of rates. Remember, there's two things when we look at interest rates for mortgages. We look at the actual rate and then the cost of that rate. The cost of that rate actually improved, which means money flowed into the bond market and rates got a little better last week. Over a 40 basis point improvement, money flowing into the bond market. But today you can see this big red bar here. Today we've lost almost all of that improvement that we had last week. So the word of the year here is volatility. We've seen so much volatility. You just take the hand that you're given when these rates come down and know that we're probably going to see something different down the road. But what's going to impact rates this week? Let's talk about that. So really a couple things. Inflation, we got some big inflationary reports coming out this week, and some retail sales. Are we buying stuff? Are you and I spending our money in stores? So inflation, there's 2 reports that come out. There's 3 reports that the Fed looks at when they look at inflation, but 2 of them are coming out this week, and it's CPI and PPI. So CPI is consumer price index, what you and I pay for stuff, and the PPI is the producer's price index, what businesses pay for stuff. And obviously, if they're buying stuff, are they passing that cost on to us? So CPI comes out tomorrow, PPI comes out Thursday, and they're both expected to be higher than they were last year at the same time. It's called a year over year number. We also see month over month numbers. And so that's not positive for rates. When we see high inflation, that's really the death of mortgage rates. So the main reason mortgage rates are up right now, and they've been going up, is because inflation, it costs more for eggs, it costs more for milk and all the other stuff that bites into our pocketbook. Well, it also reduces the return of bond traders when they're trading bonds in the bond market. So until inflation starts to come down, we've seen it get under control. So it hasn't been rising as fast. But again, we're going to see a CPI report tomorrow and a PPI report Thursday that's going to replace the year over year number. It's expected to be up, not good for mortgage rates. So we'll be watching that very closely. Next thing is retail sales. Are you buying stuff? Are you spending your money in the store? The big retail sales season. I mean, I've read statistics that most retail businesses make 75% of their money during the holidays. Crazy how much money they make just in a few months. Well, what's this number look like heading into that buying season? If we see strong numbers, that means the economy is doing well, and that's not good for rates. If we see weak retail numbers, which means you and I aren't spending a bunch of money on stuff, then that's positive for mortgage rates. So we'll be paying that attention to that. So because the CPI and the PPI numbers are expected to be up, we're locking today and locking into this week. Unless we see some shift in the expectation, then we'll move to a floating position. But we're not taking any chances. If you're in a mortgage and your lender's telling you, hey, let's float it, boy, I'd give them a call today and suggest and urge them to lock that rate today before tomorrow's CPI and Thursday's PPI report. If you have any questions on that, or if you need some secondary advice, please let me know. Hey, I've got a great program I want to share with you as well. Cross Country Mortgages came out with their own cash out refinance program that is very different. It goes up to a 90% loan to value. Now, if you look at regular conventional loans, when you're pulling money out of your property, pay off debt, do upgrades, you typically are limited to an 80% loan to value. We will now go to a 90% loan to value. Credit score down to 660. No mortgage insurance on this program. It's a game changer. And if you have any questions on it, check out the flyer that I've attached to this email. If you know somebody that is considering tapping into the equity in their house to do some upgrades to their home or just consolidate some debt, this is a great opportunity, a great program. 90% loan to value, 660 FICO score, primary home, and no mortgage insurance going up that high. And this is going to beat a home equity line any day. So let me know if you have any questions. Have a fantastic week, and I'll be talking to you next week. Bye-bye.